Hey everyone, welcome to this explainer. Today, we're tackling something that usually makes people's eyes glaze over, bank valuation. But honestly, it doesn't have to be that complicated. We're going to crack the code on price to book and adjusted book value by taking it all the way back to the neighborhood sidewalk. Yep, we're valuing a lemonade stand. So let's just start with the ultimate question for any business owner. Picture this. A neighbor walks up and says, "I want to buy your entire lemonade operation, lock, stock, and barrel." How do you even begin to figure out what it's worth? I mean, forget about those crazy complex financial formulas and giant discounted cash flow spreadsheets for a second. We just need to find the absolute fundamental baseline of its value.
And to do that, let's look at the core metaphor from our sources. Because believe it or not, a massive commercial bank, it's really just a giant lemonade stand. Think about how wonderfully simple the foundation actually is. You're gathering up cheap, spare change from friendly neighborhood aunties who just want a safe place to keep their money. In the banking world, right, that's your CASA, current and savings account deposits. Then, you use those coins to buy lemons and hand out drinks to other kids on credit. That extra coin you charge them when they pay you back tomorrow, that's the margin you get to keep. The entire banking machine literally rests on that simple foundation.
Now, you've probably heard the term book value thrown around a lot, but it's actually beautifully simple when you just bring it back to physical items and IOUs. To figure out what your stand is worth, you literally just add up everything you own. You count the plastic jug, the fresh lemons, and, this is key, the tally of all the coins the neighborhood kids owe you for the lemonade they've already drank. Then you just subtract the coins you're holding for auntie, because, well, you do have to give those back eventually. Whatever's left over in your pocket, that right there is your stand's book value. Translating that into precise banking terms, that baseline net worth is your formal book value. It's just assets minus liabilities, usually looked at on a per-share basis. It's the raw, foundational number sitting right beneath a bank's valuation. Basically, it represents the actual, tangible wealth that would belong to the shareholders if you literally stopped operations today, paid off all your depositors, and collected on all those outstanding loans. And here is an absolutely crucial point to remember. Unlike regular companies, like a software firm or a car manufacturer, we have to value banks on this book value. We can't just rely on standard earnings multiples, like the classic PE ratio. Why? Well, because a bank's raw materials and its final products are literally just money. Their assets are entirely financial. So the price to book value multiple, or PB, becomes the absolute primary anchor for valuing any banking franchise. But what if a kid doesn't actually pay you back for their lemonade? This is where our story gets a bit complicated, introducing the ultimate antagonist into valuation, human nature. You valued your stand assuming every single kid would pay you back tomorrow. But we all know that's not how the real world works, right? This harsh reality builds a pretty dangerous pipeline of trouble for the business. Let's trace it. It usually starts with an SMA, a special mention account. Think of this as the kid who's just one day late. They haven't totally run off yet, but you're definitely getting a bad feeling in your tummy. It's a leading indicator of stress. Then we get slippage. This is when a historically good kid suddenly stops paying and slips straight into the bad pile. It's the trajectory of trouble. And finally, we hit the NPA, the non-performing asset. This is when little Bunty vanishes entirely. In formal banking terms, the interest or principal has been overdue for 90 days. The loan has officially gone bad. So how on earth do you protect your stand from going totally bankrupt when a Bunty pulls a vanishing act? Well, clever owners create a specialized coin jar on the side. Every time you sell a cup of lemonade on credit, you drop a few of your profit coins into this jar, just in case. That way, when a kid does vanish, you don't panic and you don't close up shop. You just reach into the jar, you were ready for it. And this perfectly illustrates the precise banking mechanism of provisions and the provision coverage ratio, or PCR. Provisions are actual, real money set aside from the bank's profit to cover those expected loan losses. It's a direct expense that takes a bite right out of their bottom line. And the PCR? That's the metric telling you just how full that protective coin jar actually is. It measures the percentage of gross NPAs already covered by those provisions. If a bank has a high PCR, say 80% or more, it means they've got a massive, thick cushion against future earnings shocks. As an investor, that is exactly the kind of safety net you want to see. Which brings us to the big reveal of this explainer, comparing the sort of illusion of standard book value against the harsh, unvarnished truth of adjusted book value. Standard book value is super optimistic, right? It counts every single IOU as if it's as good as gold in the vault. But adjusted book value, that takes a hard look at reality. It acknowledges the Bunties of the world and says, look, we know that money isn't really coming back.
and your coin jar isn't quite full enough to cover it all. So we're going to subtract that shortfall right now.
Because of that, a really clever buyer is always going to use P/ABV, the price to adjusted book value multiple. This metric basically forces the bank to subtract those unprovided bad loans, their net NPAs, straight out of the net worth. It actively penalizes a bank carrying hidden risk that hasn't bothered to fill up its provision coin jar. P/ABV gives you the absolute sharpest, most honest number to base your valuation on. Honestly, it's the true anchor you need.
Okay, so now that we have this honest metric, how do analysts actually use this multiple out in the wild to grade what a bank is really worth? Let's take a look at the numbers.
If you see a bank trading at a multiple greater than 2.5 times its book value, you're looking at a premium franchise. A buyer is willing to pay significantly more than just the baseline net worth. Why is that? Well, because this bank earns a high, incredibly consistent return on equity. That ROE to price-to-book link is the absolute core of bank valuation. These guys are just remarkably efficient at turning their assets into reliable profit, year in and year out. On the flip side, if you see a bank trading at a multiple of less than 1 times its book value, well, red flags should be flying everywhere. This means the broader market severely doubts the quality and really the honesty of the bank's book. The market is essentially saying, yeah, we don't believe your loans are actually worth what you claim, and we highly suspect there are a whole lot of bunties hiding in your portfolio that you haven't provisioned for. So to kind of wrap this up and build out your valuation dashboard, here are the core anchors you got to keep in mind. First, book value is your fundamental net worth base. Second, because bank assets are inherently financial, price to book leads over earnings multiples. Third, adjusted book value subtracts the harsh reality of those bad loans. And finally, number 4, PABV is your ultimate, honest multiple for pricing the franchise. We're going to leave you with this final provocative thought. The next time you're digging into a bank's balance sheet or tuning into an earnings call, ask yourself this. Is the valuation I'm looking at driven by a true, repeatable earning engine, or is it just an illusion, hiding unacknowledged risks behind a completely empty coin jar? If you keep these lemonade stand lessons in mind, you'll absolutely be able to spot the difference. Thanks so much for joining this explainer, and keep learning.